There's sort of two components here when we talk about the banks, and I guess what we want out of the banks, right? There's that extension of credit, I guess, to the economy, to the folks that need to borrow. There's also the issue of capital returns to shareholders.
Yes, and they're a bit in conflict at present in the U.S. U.S. banks, certainly at the regional level, are under quite a bit of pressure, and as long as the rates remain high, they have a serious problem, both their assets and their liabilities, flight of liabilities and markdown in assets. So what are they going to do? I think they just a race against time for them. They've got to hold it all together. We think they're a somewhat unsavory place to be investing at present. And, in contrast, European banks overcapitalized in general, and returning capital to shareholders through dividends and share buybacks. That's it's interesting to see the turn of the tables after all those years of European banks being underperformers versus the U.S. It has all changed.
Chris, I am curious, when we talk about economic conditions, or at least we try to read the tea leaves of what those economic conditions might be, we do know that, well, having credit, basically banks lending money to consumers and to businesses, is a big part of the grease for our economy here. And there are concerns that that grease just isn't there, at least not into the level that we want it to be.
Well, Romaine, I think the banks have really slowed down their corporate lending and their direct lending programs as a result of the regulations that came in 2008. But they're definitely being more conservative. The regional banks hold a lot of real estate debt and office real estate debt. And you guys have talked a lot today about how the real estate market is due for write-downs and declines in value. That's going to put pressure on their balance sheets as in some cases the owners throw the keys at them. So I'm worried, there's still a lot of private credit that has now come in from institutional investors into the market that can fill that financing gap. Those rates of return look pretty attractive now that there really are yields in fixed income. That said, I think the regional banks are going to continue to feel pressure just because their natural market is certainly compressed. They've got better interest rates to help them, but it's going to be tough.
That natural market is compressed right now, Chris, and you mentioned commercial real estate. That's obviously a big focus as well. But then even Jay Powell, when he was on Capitol Hill this week, was asked about the need for additional, or I should say higher, capital requirements. And he pretty much, at least in the way that Jay Powell speaks, affirmed that.
He did, Romaine. And I think that, they would like to see stronger, safer banks. We took a lot of time to look deep into Silicon Valley Bank and understand that exposure, First Reserve Bank. They really were outliers when you look at the inflows and outflows to banks, their capital structure. The regional banks, there are some that are weak and some that are strong. The money center banks really are in very good shape in the USA. So I don't think this is a banking crisis. The stress test will be painful for some, but I think the Fed really is trying to watch it closely and keep the banking system supported.
Sarah, you're probably a little bit more of an active manager than what Chris would be. I am curious, does what happened with the banking crisis, the regional banking crisis back in March, and the potential sort of specter of additional regulation, does that change your broader investment thesis overall?
No, it doesn't. We're value managers at Causeway, and our fundamental portfolio is international and global. And no matter where we are in the economic cycle, whether we're in a slowing phase or an expansion, we're looking for companies engaged in operational restructuring. So something has gone wrong with their earnings, and the new management or the reformed management is there to fix it and reaccelerate. And those companies exist all over the world. So the current environment does not, but it doesn't help us when central banks get too accommodative and they take rates down to zero, because then there's no cost of capital. And then using a valuation approach becomes somewhat challenging. And we are beyond that. It's a new era now. So it's very exciting to be involved in valuation work and find that our toils are rewarded.